Hey everyone, welcome to another episode of the Mindful Investor Podcast Show. I'm Steve Rosenberg. I'm the host of the show, and I'm the head of investor education for Mind Property Management. And, one of the reasons we do this show is we have learned that, myself as an investor, I've been doing this for 20 plus years, and it doesn't get easier. I can tell you that right now. It's like you're constantly changing currents, changing streams, changing everything, and the rules change constantly. Whether that means your partners and your business partners are changing out, the types of properties you're purchasing. I can tell you the word Airbnb never existed when I first started, along with certain ways that you would buy deals and finance deals and other stuff. And if you're not staying up on the times and you're not current, you're probably going to be dying. And so it's kind of like a tree. You're either growing or dying. You never stay the same. And so the guest that I have on today is we're going to talk about the different types of banking that's going on when it comes to your financial assets. So Sarry Ibrahim is the CEO of and president of Financial Asset. And I'll let him explain a little bit more about what he does because I'm sure I will butcher it. But essentially working with investors to grow their wealth and protect it from creditors as well as predators and make sure that, what they're doing, we all know it's not what you make. It's what you keep. And how do you keep it and pass it on for generational wealth is really the key. And we're going to talk about how he works with professionals to make that happen and make it continual to happen. Because as we said, I'm sure the term infinite banking maybe didn't exist back when I started, but it exists now. So Sarry, first of all, thank you so much for taking the time to be on the show with me. I appreciate that.
Hey, Steve, thanks for having me on. I appreciate it.
No problem. So I'm sure I butchered it a little bit about what you do and who you are. Can you kind of maybe correct my explanation and tell everybody what you do?
Yeah, definitely. No problem. So I'm part of the Bank on Yourself organization, which we use the Bank on Yourself concept, or also known as the infinite banking concept. And what that means is it's the utilization of dividend paying whole life insurance, mainly for the cash use for the living benefits. And a lot of our clients are real estate investors and business owners. So we show them how to structure these policies in order for them to grow safe, predictable, and guaranteed wealth on a tax-favored basis. There's also a lot of asset protection involved. So that's pretty much what we do. We use the infinite banking concept, also known as the Bank on Yourself concept, for real estate investors and business owners.
Okay, so talk to me like I'm a third grader as far as that goes. So we got an investor. I own properties. Let's say I have equity in my assets. Are you looking for people who have equity? Or are you looking for people who do not have equity? And is there a certain amount of asset that you want them to have of wealth?
Yeah, definitely. Good question. Yeah. So pretty much it all varies. There's different ways to fund these policies. They're all funded in different amounts, different companies we deal with. It all comes down to like a financial analysis that we do with clients. We figure out where they're at right now financially, where they want to go. We see the equity they have. We see their liabilities. We try to figure out how we can start structuring these policies for them that would most help them. There's different ways to fund it. You could fund it monthly, annually. You could do a single premium policy, which is the one-time payment. But I kind of want to back up and just first talk about like whole life insurance and like what it is and the functions of it. So it pretty much has two main functions. It has one, the actual life insurance part, like in the title, and the other part has cash value. That the cash value is almost like a savings account within the policy. So you could use this cash for whatever you want, no restrictions. And with this cash, it grows guaranteed every year. It earns dividends and interest from the insurance company it's a part of. And that's why a lot of real estate investors would allocate funds to a whole life policy, grow the cash value, and then be able to borrow from the cash value to use for real estate investments. Again, you could use it for whatever you want. It's not only for real estate investments. You could use it for whatever you want. So pretty much there's a capitalization period, a time where we start building up the policy. We start funding the policy. And again, it could be done monthly, annually. It could be done a single premium. I've worked on policies as low as $300 a month. And I've done a case recently, a $400,000 deal where a real estate investor sold one of his properties, $400,000 in cash, took that cash, bought a single premium whole life policy, and then instantly had now cash value and a life insurance part. So a lot of different things we could do. And we don't necessarily look for a specific amount of equity. The first step was the analysis. We get an idea of what the client is doing and where they want to go. And then we start building from there.
Okay. And full disclosure, I actually have a overfunded life insurance policy myself. So I am familiar with it. I'm not that familiar, but I do take part in that practice. So I do know that is something that is a great concept. It's a great idea. And it's something that not many people understand. And I think, the way our brains are set, and I'm sure you probably come across this a lot, that if somebody doesn't understand something, they just shut it down and say no, as opposed to saying, okay, well, never heard of it. Maybe I should look into it. And so I've learned that is what wealthy people do. And I know that that's something that is another form of not only asset protection, but creating wealth for yourself and your family. So let me ask this. How did you, I guess the first question, how did you get into something like this? Like, how does this happen?
Yeah, definitely. So I started 5 years ago. I was working for Allstate as a business consultant. I was working on like commercial policies and like risk mitigation strategies. And then from there, I went into Medicare, where I was working with like Blue Cross Blue Shield, Humana, Cigna, different health insurance companies. And I was working with retirees who were like 64 years old, and they were merging off their employer plan into an individually owned Medicare plan. So I was like their broker, helping them find the plan and going through all that. And during that time, I started building relationships with these clients. And one of them asked me about life insurance. He's like, hey, can you find me a life insurance policy? It has some sort of cash value. I didn't really understand much of what he was saying, but I told him we had a good relationship. I told him I would do research. I'll get back to him. So I started researching books on Amazon. That's one of the ways I like to learn. I like to read books. So I went to Amazon and searched for books about life insurance. And then the Bank on Yourself Revolution book by Pamela Yellen came up as a recommendation. I bought it, read it. I loved the book. And it pretty much talks about the Bank on Yourself concept, whole life insurance. It even compares it to like 401ks, IRAs, and different vehicles out there and how it could actually be better. And I don't want to just, bash all those vehicles. I just want to say like there are additional benefits that you'll find in a Bank on Yourself policy that you can't find in other financial vehicles. So it opened up my eyes. I ended up buying my own whole life policy. I became a client. And also I went through their program. They had like an 8-week training program that I went through, and I became an authorized representative. And that's what I've been doing since.
Okay. Wow. So kudos to Amazon for getting you started. So let me ask you this, like, what are you seeing some of the biggest financial challenges that real estate investors are facing right now? Because we all know lending is getting tighter, right? Mm-hmm. And so we don't know what's coming around the corner. We all know that people are overspending on stuff right now, which, the pendulum swings both ways, right? We know that. I've seen this multiple ways that this real estate has cycles. This is just another cycle. It's going to go boom, and then it's going to drop. And the people that are over leveraged and maybe don't have the right business model will end up losing their business, which means losing their properties, which means the lenders are going to tighten up. So what do you see as the biggest challenge that investors are going to face, and how does this help that?
Yeah, absolutely. So one of the challenges I see is it's a liquidity aspect. So like either like you need the liquidity, you need cash as a real estate investor, right? Because there's a lot of delays. There's delays in renting out properties and selling properties and refinancing. So there's a lot of delays in that, and liquidity is king in real estate investing. And then also the contrary to that is having too much liquidity. Obviously, real estate investors are not going to park large amounts of cash in a checking account or savings account, because you're going to lose opportunity costs. You're going to lose to inflation. So you kind of have to keep reinvesting that money, but then it can kind of go back to that problem of liquidity now, where if you do invest in properties and you need that money out, you either have to sell or borrow against. And as you mentioned, it's not always guaranteed that you'd be able to borrow against that, because lenders tighten up their grip. So now we're kind of all over the place with all these problems. So I think the Bank on Yourself concept really tightens up, and it meets in the middle, where you have money working for you. It's earning compound interest, and it's also liquid at the same time. So you could borrow against it, still have it grow, and then use that for real estate investing or for whatever you want, and then be able to pay back the loan and still have the policy grow as if you've never touched it. For example, let's say you have a whole life policy, you have $100,000 in cash value, and then you come across a real estate deal or a business deal, you need $50,000 in cash. You can go to yourself, you can go to the company you're with, borrow $50,000 from them, leveraging your $100,000 in cash value. So you're not deducting from that principal, you're just borrowing against it. Now, what happens is that your $100,000 cash value keeps growing, and then you have a loan that you have to pay back to the insurance company. So let's say you make money on that $50,000 investment. You're profitable there, and you're making money in the policy, because your policy continues to grow. Eventually, your cash value is going to outpace what you paid it to the loan. So you have a positive arbitrage within the policy, and you have a profit on the side. So now your money is doing two things for you at the same time. And this is exactly what banks do, Steve. Banks have billions of dollars in whole life insurance. They borrow from those policies. They loan them out via credit cards, lines of credit, mortgages. They earn interest from those and profits from those, and from the actual policy itself. So I think that's really important for real estate investors to know, is that it's not just cash on cash, where you just have to use your cash for everything. There's kind of a middle balance where you can park your cash somewhere, have it grow compound interest, and still be able to use it at the same time.
Now, correct me if I'm wrong, but there's a maturation. It's got to mature a little bit, correct, for you to be able to pull off of it. And I think it was a certain amount of years, if I'm not mistaken. Like what is the downside to having this policy? And as far as whether it's time or, I'm sure like everything, there's not everything's perfect. So what are some downsides that people need to think about?
Yeah, there are downsides. Like one of them is there is a capitalization period, a period of time where you have to build up the policy. It's not like you could put 10,000 in and then borrow 50,000. You'd have to put money in, and usually with whole life insurance, the fees are the highest in the first 2 years. That's when every dollar put into the policy, most of it goes to managing the policy in the first couple of years. After you have the policy built up and you're paying the recurring payments, then your cash value, it's going to earn dividends and compound interest from the insurance company. And then eventually you start to see like a break-even point where your cash value starts to exceed what you're putting into the policy. So there is it takes discipline. There's a savings period, a period of time where you have to capitalize the policy, build it up. You can, however, borrow as soon as you put money in. Like, for example, if you put $10,000 a year into a policy, like year one, your cash value would probably be around $5,000. In year one, you could put 10,000 in and then borrow 90% of $5,000 and then have the policy continue to grow, continue to earn interest, and then you could use that money. So you're not necessarily locking up your money, but if you do want to get to the point where you're using, your policy for hundreds of thousands of dollars in deals, there is a capitalization period to get there.
Okay. Let me ask you this. If I was a new investor and I'm watching this show and I'm trying to understand how does this fit, what are some lessons that you would give someone who's either new to real estate investing or new to just this concept, meaning they've done real estate investing before, but they're trying to wrap their heads around this? What advice would you give to people that are trying to get involved in this?
Yeah. So there's only three things you could do with your money. You can either spend it, invest it, or save it. And I definitely think that you pretty much a lot of people make, for example, I forgot what the stat is, but 60% of Americans don't even have $1,000 in a checking account. And it's not because that's a income problem. It's a savings problem. It's very easy for us to use money nowadays. We have, our mobile apps, we have credit cards, debit cards. So I think you need to figure out a way that to help a lot of people is you need to figure out a way to grip your money where you're earning money. And then before you spend it, you're able to put it somewhere that can earn you interest and then take out money from there to pay your expenses. So pretty much something in the middle where you can kind of grip your money. That's what I would recommend. And you don't need to be rich to do this. You don't need hundreds of thousands of dollars. Putting in $300 a month, that's how I started off in this policy. I put $300 a month in. That'll make a huge difference because every year it's going to grow and I always have access to it. So I really like this, Steve, because I'm not I'm locking up my money, but I'm not locking it up to the point where I can't touch it anymore. I can touch it. It only takes me, I just have to fill out a form. It takes me about 5 to 7 business days and I can borrow that money from the insurance company. So it's liquid, but it's not too liquid. That makes sense.
Yeah, it's not as easily accessible as money in your pocket. Well, I guess, do we even see money in our pockets anymore? I don't think we do, right?
Yeah.
I got a question for you. Have you ever heard the term rabbit ears? This may show how old I
am. No, I haven't. What is it?
So rabbit ears, when you were a kid and you had no money, you'd pull your pockets out to show that you've got no money in your pockets, and that looked like rabbit ears. So rabbit ears was the term. So that's for people watching, that just shows how old I am, that I actually have dealt with actual money in my hand, unlike other people who nowadays, they don't see money, which is a good and bad thing. And going to your point is that most people don't even see the money that they make. It's just, It's a digit in a digital, it's on your phone. That's the extent of how much they make. Whether it was $1 a year or $1 million a year, you just add zeros. It's not relatable, which I think is by design to make us more of a consumer society, and it makes it easier for that to happen. So I like the fact that you have those barriers up there, so it'll help the average investor not just be able to take that, which is great.
Yeah.
If there was an investor watching this that said, okay, I like this, how do I capitalize on this the most? Right? Because I was at a point when I talked to my wealth advisor, and he said, look, this is what you need to do. You need to do this, this, and this. And that was the answer that he gave me. So what would you say is the best solution for people that really want to double down and do this?
Yeah, definitely. Sorry, I'm having a problem.
Your phone freeze on you?
Yeah. All right. So sorry. If you really want to capitalize on this and you really want to
if somebody wants to capitalize on this, how would they do that?
Yeah. So the example I mentioned earlier, a client of mine, he had a real estate property. He sold the property for $400,000 in cash, took that cash, bought a single premium whole life policy, a one-time payment. And then as soon as he did that, he had cash value available of $375,000 in cash value. And then he had a death benefit of $580,000. So what this client did is he just turned $400,000 into two things now. It's doing two things for him. He has cash value of $375,000 in year one, and also a death benefit of $580,000. Now, the cool thing, Steve, is both of these grow every single year without any more money being put into it. I think that it's hard for me to kind of push a client into a special product or a special company, but that I've seen as like the most beneficial because it's instant liquidity and it's a lot of liquidity too. But of course, the downside is you need $400,000 in cash to implement that. So if you are a real estate investor, you do have that capital, I think that would be a really good fit. Of course, we have to go through a financial analysis. We have to kind of like really see if this will be a good fit. But the 400,000 that I've seen as like the most attractive and also the most like favorable when it comes to using the bank on yourself concept for real estate investing. And I hope that answers your question.
It does. It does. And, I guess my question, another question backing up to that is, when people start growing, again, I think I'm a big believer that I like team and leverage. I think that's how you get more successful. Talking to you and getting that conversation going as to what's right for me may not be right for you. And I think having that team, such as property management, having the realtors, having all of these people in place, financial advisors to give you that, I think it's all collectively to get you to where you want to go. What are your guys' thoughts on doing that with team, like having property management and all the other assets collectively together that you would work in conjunction with?
Yeah, absolutely. I love that. The team, that's my favorite part, is having the team, having, as you said, the realtors, the property managers, the other wealth advisors. And I think the bank on yourself concept or the infinite banking concept, it's not an either or concept. It's not either, you put money in a whole life policy or you put it in real estate or you put it in the stock market. It's something we sit down on a table and we go through all of these, we go through all of these things and we try to connect it with the different investments you have. So absolutely, we're not tax professionals, we're not legal professionals, but we do like to sit with those legal professionals and tax professionals to make sure this is a good fit all around. Financially, it's going to be a good fit. Tax-wise, it's going to be a good fit. Legally, the asset protection side to it, and in connection with your partners and the LLC or however you have it structured. I definitely think that the team structure, we're a component of that, and we like to be a part of the team.
Yeah, I think it's important, and I think that a lot of people, a lot of investors, when they go down this path, they don't think to connect all the pieces, right? They don't have one person talk to the other, talk to the financial CPA. And I think it's very, very important that everybody talk to each other to make this, again, it's not what you make, it's what you keep. And more importantly, are you able to create generational wealth regarding everything that, is going to happen? And I think that, look, we all know right now, a lot of people are going to lose that wealth. So I think that that's the challenges that we have. Let me ask you, what are your thoughts on what's going on right now with the economy? 2021's around the corner. We got elections. We got all this stuff. Where do you see this whole thing going?
Well, Steve, I think it's been crazy. Obviously, 2020 has been a crazy year, and
that's all I gotta say is 2020. Like when things are going sideways, just be like, 2020, man. That's what it is.
Yeah. I don't know what's going to happen, especially after the elections. I don't know what's going to happen, but I do know for sure there's a lot of uncertainty. People don't know what's going to happen. And unfortunately, I don't think the indicators of the stock market are true indicators. I don't think that's actually a representation of our stock market. Of our economy. And people might think I'm crazy for that because we use like the S&P 500 and other indices to measure our economy. But I don't think that's the true indication. I think look at other indications. Look at unemployment rates. Look at mortgage default rates. Look at student loan debt. Look at all the other debt we've accumulated. I think those are true indicators of what's going to happen. And I definitely see a crash coming around the corner. I don't know when. I don't know how bad it's going to be. But I think that the thing is that people need to, if it comes to your retirement money, if it comes to your quote unquote safe money, that cannot be somewhere that's volatile. It can be affected by market conditions. And another really cool thing I like about the infinite banking concept is it's not necessarily either or either. You put it somewhere, that's going to earn you X amount of interest, or somewhere that's, riskier. It's about taking control of your financials. It's taking control of your financial life and making sure that external factors like an election or a pandemic or a virus won't hinder your financial situation.
Yeah, and again, I think you're right. I believe that a crash is coming. I think crashes are always coming, and so are booms. I think it's that real estate is cyclical. It's like the ocean; it never stays the same. And I think that real estate goes in. I've always learned that it goes in 7-year cycles. So if you if you go back to, whatever you want to put the face of the reason why. So you talk about 2001, 9/11, right?
Mhm.
That everything crashed and then it boomed. And then about 7 years later, which was 2008, that was systemic, but whatever you want to call it, crashed. Then 2014, you had the $130 a barrel oil prices. It crashed. Some of it was micro, not worldwide or nationwide. So that was 2014. Now we're about 6-7 years later, and we're back at 2020, and it's crashing again. So I think, you can label whatever you want. I think crashes are inevitable. And I think that the people that are wealthy are the ones who know crashes are coming, and they get on the right side of the fence or the right side of the game, if you will, to be able to know when that crash is coming, and they know how to prepare. So I think some markets you have buyers markets, some markets you have sellers markets. And I think you having the knowledge to say, yeah, a crash is coming. I need to move my positioning of my finances here to be ready to buy, or vice versa, whatever the case may be. And again, I think a boom could be good and bad. I think it could be, it's going to look, more wealth, I believe, will be created in the next 18 months than in the last decade. It'll just be by different people. And because, a lot of people have gotten wealthy, but not like that's going to happen because everything's about to go on sale. So a crash is bad for some people, but it's good for the other people who are prepared. So like you had said, if your finances are in order and your knowledge level's up, it could be very, very wealthy for you. And it could be a great time. And I don't know what your thoughts are or your positioning on that. I mean, do you agree, or am I way off here?
Absolutely. People will get richer. People do get richer in a crash. It's happened throughout all of history. And I think it's the people who have the cash, the liquidity, and also the knowledge of all these things that are going on. Usually those two, for the most part, tend to go hand in hand. People who are very wealthy also are very observant of economies and currencies and things like that. So definitely, absolutely. And I think that to connect that with infinite banking is that you have your money living somewhere. So in other words, your cash, you have the cash available to take advantage of these discounted assets, and it's because your cash is backed by an appreciating asset that increases naturally without having to do any work, and increases regardless of market conditions. So you're parking your money somewhere that's growing regardless of market conditions. And when conditions go down, you still have your assets inclining, and you're able to borrow from that, take advantage of those low costs. But if you're doing what everybody else does and just putting your cash places where everybody else is putting their cash, like, real estate, and I'm not bashing real estate investing. I'm just saying that if you just simply trade all your cash for real estate properties, and then there's a market crash, banks aren't lending, then you're on the same level as everybody else now. Your money's tied up in dry walls, and your market values on your properties have dropped because the economy has dropped. And then also the liquidity aspect, banks aren't going to give loans in that situation, or if they do, they're going to be really high interest and not in your favor. So you're kind of like on the same boat as everybody else. But if you have your cash sitting in an appreciating asset, and then you borrow from that, pay your real estate, and then be able to fund your whole life policies back, the loan periods back on them, then now you're in a different situation. You're in a non-volatile situation at that point.
And, I think that a lot of people, even though they realize that when you own real estate, you own a business, I think a lot of people are emotional. I think right now, all the purchasing that we're seeing going on in this industry is emotional. I think that, people are buying out of a frenzy, and that's what's driving up costs. Because, I don't know where you are, but everywhere that I talk to in the country is, they're saying, man, it's going crazy. It's going crazy. It's like, that's just like a shark feeding frenzy. Nobody knows why they're eating. They're just eating, right? And I think at some point, they're all going to be like, okay, I'm done. And right now, I've said this several times, is that it reminds me of the final grand finale fireworks show at Disneyland before it goes dark and everyone has to leave. And so I think right now it's like the fireworks are just popping and everyone's buying and buying and buying, and it's going to go dark. And all these people are going to be holding houses going like, I overpaid for this. Like, what do I do now? I thought this was the time. So this is the preemptive. I think the people that know what they're doing are the ones that once it goes dark, they put on night vision goggles and then they go hunting for the deals they want to hunt, because they're just sitting right now, like myself. I'm just sitting, waiting. I'm not buying out of emotion. I'm just waiting for this to happen. And once it goes dark, I know what my numbers are. I know what I need to have. And then I go find them. And it's not emotions. It's not should I or shouldn't I. I know what I'm doing. And so I think that a lot of people are going to get hurt because of the fact that they're doing this right now, thinking that this is going to just keep going up, or the hope and pray method. And I'm not, again, it's just my opinion. I could be wrong, but I just don't see it happening that way. And I agree with you. The ones that all the money is in the drywall and they haven't positioned themselves correctly, now with that being said, I think that you're only hurt if you have to sell it.
Yeah.
If you're holding on to it, I mean, my parents bought a house in Los Angeles for $22,000 in 1962. I would say, that house is doing okay right now in the hills of Los Angeles. It's not 22,000 anymore. So it's gone through many booms and busts. Unless you sell it, that's a different story. So I think that, the word for people watching this show is, yes, it's going to go up and it's going to go down. I mean, if you look back at 2008 recession and you look at the actual graph, it looks like such a small blip. And I clearly remember, I mean, I was buying properties during that time. And I remember it was almost like the world was flat and we were all about going off the edge. And it was like nothing. I remember this. Nothing will be the same. Banking will never be the same. Our life as we know it, the sun is the moon. This is blah, blah, blah. And now you look at it and they're like, oh yeah, I remember 2008. There was like a banking issue back then. Wasn't it? Something happened. And you're just like, when you live through it, it's different, right? And I think that a lot of people that are in real estate right now, they've never gone through a crash. So they're about to learn what happens when the market corrects itself. And I think that, the vacation rentals, the Airbnbs, I think it's a good model, but I think that this happening showed its kryptonite and it showed that there's a weakness in that business model. Not saying it's a bad model, but I think they're going to have to revise it for having that type of situation. Could it ever happen again? I don't know. It could, but how many people have the money to hold on for a year or two? I know Airbnbs are doing great right now, or the majority of them are, but again, I think that, the majority, the whole point of this, what I'm saying is that they need to realize that they're running a business, and having advisors like you and having other people give them that advice of where to put their money. It's not, I don't think it's ever a set it and forget it. I think it's set it, place it, then move it, set it, place it, move it based on the surrounding environment.
Absolutely. I agree 100%.
Well, I appreciate you coming on today. If somebody wants to get a hold of you, find out more and have like an in-depth conversation, how do they find you?
Yeah, definitely. They can go to finassetprotection.com. It's FIN, assetprotection.com. And all my consultations are free. In there, you could book an appointment. All of them are virtual too. About 99% of our clients are virtual. So you can go there, book an appointment, finassetprotection.com. And as a special, Steve, for your listeners, if they book that free appointment, they say they came from your show, I'll send them a free copy of The Bank on Yourself Revolution by Pamela Yellen. It's like $15 on Amazon, but I'll send it to them via Kindle for free if you just go book an appointment there.
Great. Well, I appreciate it. And again, I think this is something that I think we all need to learn different avenues. And I think it just educates you and you understand how money works, because understanding the flow of money and how to move it around, it's not the way that you may think as you grew up, that you just put it in your savings or you put it somewhere and set it. That's not, it's the velocity of money. And I think that you guys do a great job, Sarry, in your company of explaining to people how you can make that money work and move to the best of your advantage. And that's, to me, the key, right? So I really appreciate that. And I think the knowledge that people will learn, if anything, just to learn about the concept, I think is great, because now, okay, I've got another feather in my hat. Should I ever need it? I've got an idea. And, it's a matter of doing it over time, not just, if you need it tomorrow, you don't do it today, right? This is something you should have planned out, because I think creating wealth as well as creating generational wealth is something that's planned. It's not something that, and it's planned over months, years, and decades. It's not hours. It's not an hour decision like social media. And I think that people need to realize that this is something that's got to be methodically planned and thought out. And is it part of your strategy? Is it getting you to your goal? Does the team agree with this? Or is everyone on board? What are the expectations? And I think that's, again, this is when you start bringing team in to have these more intelligent conversations to make you a more sophisticated investor when it comes to this world. So, Sarry, again, thank you for being on today. I really appreciate it. For those of you that are looking to talk with us about property management, Mind Property Management, we are in over 19 markets. I think we may be in 21 markets now, nationwide, the most investable markets. What's great about that is we have proprietary software. And should you want to invest in San Diego, Seattle, Las Vegas, Phoenix, Houston, Tampa, Charlotte, any of these areas, you'll have the same system. So having the same systematic model and people to help guide you to get to your goals. And I don't think it's an and, I think it's an or. I'm sorry, I don't think it's an or, I think it's an and. You could have properties all over and you'd have the same system to run on. And as we know, when you're trying to diversify your investments, having to babysit so many different people is not the best way or the best use of your time. So go to our website at mind.co, mynd.co. There you can get all the information about the company, about us, past shows, episodes, as well as other ones coming out. Also, if you do like this, please make sure that you like, comment, and subscribe so you can get more videos like this in the future. I'd like to thank Sarry for coming on with me today, as well as Mind Property Management for allowing me the platform to have the show. I'm Steve Rosenberg, Head of Investor Education. Thank you everyone for watching, and we will see you next week on the Mindful Investor Podcast Show. Bye-bye.